Oh, sorry.
Okay.
We're going to go ahead and get started. You've had an opportunity to meet Eric Munson, and he is obviously in the big chair today because our new treasurer, who hopefully will be joining us in a little bit, is up at the state capitol.
He's in the Capitol's committee meeting going on with some legislation. I think that's probably where
Clint is.
Clint Roden is also. They'll be down here as soon as that bill passes, but I'm going to fill in right now. And again, I appreciate you being here in person and all those on the Zoom with us. I'm Eric Munson. I'm the Chief Deputy Treasurer, and I'd like to call this meeting to order today.
And joining us, just so you know, Eric, we have Alicia, who is with the Arkansas Division of Higher Education. And she is, I believe, you're at a school, maybe making a presentation or something today. And so she's joining us remotely. And then Amanda White and Jamie Fairchild are both with Vanguard.
Okay.
So,
Good morning and welcome.
Good morning.
So with that,
I'm going to, again, we call it to order. We're going to need, did everyone have a chance to review the minutes of the meeting? And if you, I'll give you a minute if you need to review those for a little bit, then we'll have a motion. I need a second to approve the minutes. If you review them, everyone good or?
Motion.
There's motions or second?
Second.
Thank you, Alicia.
Okay, we approve the minutes. And what I'd like to do now, we'll go through this, but on the business, we have very capable hands with Fran, Jansen, and Chris to let them guide us through this part of the agenda right now.
Okay, awesome. Thank you, Eric. So just a few highlights to mention. In January, Chris and I had an opportunity to present to the HR team of the North Little Rock School District about the employer, 529 employer. They actually had a school employee come and ask about it. So we were very happy to get on that call and kind of walk them through, and they were surprised that it was easier. There's a big misconception we're finding. People think it's this big batch thing and it impacts their payroll. So and then similarly, we had a conversation with the HR director at St. Bernard's Hospital in Jonesboro, which is in southeast Arkansas. And they have about 4,500 employees. And so we're going to do some follow-up with them and try to get in front of them to talk about the employer program. And to assist us in those conversations, we've been working with Dave and the marketing team at Ascensus and putting together a brochure that is kind of a USA Today version that walks people through the benefit from an employee-employer perspective. We're finalizing that, and I'll bring it to the next meeting so everybody can have it. But we're going to utilize that piece to get a little more aggressive in following up with folks strategically about the employer benefits. And to that end, I would ask Rod, one of the things we were going to do, and Alicia too, we were going to lean on the agencies that are kind of represented around the table here to maybe do an introduction to your respective HR people, because obviously if we're out in the state promoting it to businesses, we need to double check our own backyard. So we want to make sure that we're giving equal time, if not maybe preferential time, to the state agencies. Sure. So Alicia, we'll follow up with you on finding out who the key person would be there. So okay, awesome. Then moving on, it's baseball season again. And so as we've done the last few years, we are sponsoring the Arkansas Travelers. And we have the naming rights to the kids' game zone. And with that comes, if kids are going to participate in any of the on-field games, they have to sign a waiver, which basically is saying nobody with the Travs or us, is responsible if little Bobby falls down and breaks his arm. but we get access to those waivers. And so we are able then to follow up with the parent. I mean, they can opt in or opt out, but the tribes are very good about sending us the names. So we'll, depending on how many kids they have that night. So, and the season's April through September. So it's a nice stretch. Then we'll also, they have a huge jumbo video board, and we'll have our logo up there. And then 3 games are going to be designated 529 night. So we'll, and they're so good. I mean, they are really, really good about giving us shout outs. We're also doing a baseball sponsorship with the Northwest Arkansas Naturals at our best ballpark. So we're just doing a sign up there that has a QR code, but it's in the kids zone and it's right by the bathroom. So we thought that was good placement. And we'll be able to track that QR code and identify specifically which, that it came from that ballpark. So that's kind of the marketing update, just some highlights. Any questions before we move on? Okay. Well, I'll take it from here. So next, we have a couple things up for approval. With the departure of Treasurer Milligan, we need to officially add Treasurer Lowry as one of the signatories, authorizing him to co-sign on checks that come out of the 529 accounts. So once he's added, he'll join Maria Markham, who is Alicia's boss, and then Clint, your boss, as our 3 signatories. So I'd like to ask for a motion to formally approve and set in motion having Treasurer Lowry added.
Motion.
Clint, thank you.
I need a second.
Second.
Thank you.
Oh, I thought you could say again. Awesome. Okay, well, we'll move forward with that then. And
All in favor?
oh, sorry.
Aye.
All in favor of having Treasurer Lowry's signature?
Aye.
Aye.
Okay. Thank you. Opposed? All right. Ayes have it. That's right. Hey, we need to laugh a little bit.
Yeah, I'm just trying to zip through here. Next are the checks and invoices that are in your packets. So Rod and Alicia, you should have those to review. And if there are any questions, certainly let me know. You have it, I don't know.
Yes, I have.
Did you? Okay.
I had it in pages.
So once you've had a chance to look at that, I'd like to ask for a motion to approve the checks.
So move.
Second.
Moved and seconded to approve the checks, invoices paid. All in favor, say aye.
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 Opposed? Okay. Ayes have it. Thank you.
Then the last item to present for approval is the adoption of Amendment 8 to the Program Management Agreement of the 529 plan. And it should be in your packet. And I'm going to let Dave kind of just generally, it's more of a
Yeah,
operational
it is
change.
operational. I mean, essentially does a mail statement, scoring statements. We have a partner who's been doing it for a long time, Venture. I mean, and they worked out great whenever, I mean, we had, 10 plans. Now that we have, literally millions of accounts that we mail to every quarter, we needed to find a better source. And one of the main reasons, I don't know if you guys have experienced this with us, but when we mail out quarterly statements, that actually takes a project, and we start that project about 3 or 4 weeks out before the end of the quarter. And we have probably 6 or 7 tech team members who write code, who could be doing projects for you guys who are working on delivering these statements out. It's just a real cumbersome process. So we actually have a relationship through one of our other divisions with this company called O'Neill. O'Neill's done a great job for this other division. So we've hired them on to do the statements across the board for our plans. They'll do a much better job. We won't have to do a project. That frees up all of our tech resources. And we'll be able, if you're familiar with our statements, they're black and white, they're pretty mundane. From what I'm hearing, I'm crossing my fingers, is that they're gonna be color, they're gonna be coming in color. They'll look a lot more like a Vanguard statement than what they look like now, which if you've seen a Vanguard statement, they do a great job there. And no offense against, iShares.
BlackRock does pretty things.
But yeah, so anyway, it puts us in a much better place. So we think the changeover will take place sometime before the July statements go out.
Okay.
So you'll see next month, you'll see our normal. So then in July, you'll see better statements go out. But the direct plan, the Arkansas campaign is one of the few actual agreements. I think there's maybe two that actually mention venture. So we have to take venture out and add in O'Neill. So that's what the song.
So, and then,
The amendment does.
and so because of the way our bylaws are, we need to ask for the committee to approve that we move from venture to O'Neill for this purpose.
That's it.
Do we have a motion?
Motion.
Is there a second?
Second.
Thank you.
Or motion second? All in favor, say aye.
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 Any opposed? All right. Thank you all.
All right. We'll move on to the reports now for Dave.
Yeah. Appreciate what else.
He's ahead of you.
All right, thanks. So I don't know if you guys saw the news. I don't want to steal any of Don's or Amanda's thunder, but Jerome Powell came out with a statement this morning that rates are going to continue to increase, and it may be at a faster rate. So this, go ahead.
Can you say that again? I didn't hear what you said, Dave.
Jerome Powell.
Oh, okay.
Yeah, the release a statement this morning that rates are going to continue to increase and at a faster rate than we've already seen. So these lines, I mean, if you look at the gray line, which was 2022, and look at the black line, which is 2021, you see an incredible difference. The last year was absolutely ridiculous, and it doesn't sound like that's going to change much in the next 12 months. And again, I don't want to take away from investment partners, but right now we finished the quarter finished February at 532 million. That is up from the previous time we sat down together back in December, but it is it could be a tough moving for the next quarter meeting. I suspect those numbers will be lower, and the numbers don't represent anything about the health of the plan. It is purely about the market. The market drives the valuation of the assets in the plan, and that's what we're unfortunately tied to. We'll see in a second that your flows are pretty dang good compared to what kind of year we had in the previous founding year. But that's where we are right now at the end of February. Going with the next year and contributions. And we're seeing, so we saw, and this is just year to date, but there's 2 months, 2023 contributions, January and February, 12.36 million. That is slightly down from what we saw last year as the market begins to turn, right? I mean, so as we go forward in the months that follow, you'll see this change a bit to where I think 2023 contributions will start outpacing what we saw last year as we went through that really, really crazy market, even though this year isn't going to be that much better than it looked like. But 12.36 million, you go to the next slide, we look at withdrawals, and we see that we had fewer withdrawals than we had in 2022 year to date. Again, this is just 2 months, January and February, but 10 million versus 12.1 million. So if you do the math on the next slide, that means you're net positive versus year to date. So net inflows January and February were 2.2 million. That's a 1.78 million increase from 2022 for the same time period. So that's very positive. And then you look at next slide, funded accounts, we've crossed over the 34,000 mark. And again, these are actual accounts with money in them. We look at accounts 2 ways. We look at those that have money, and we look at those that don't have money. And some of those are accounts that just opened. Some of their accounts are older that were open with all the intent to add money. Fortunately, no one ever did, but we leave them there. We're not going to close them down. We keep bringing them, hope of the strategy with those unfunded accounts that someday someone's going to actually have money to them. But But you got over 34,000 accounts with money, with assets up to there. And then you look at funded accounts by residency. Most of the accounts are in the state of Arkansas. But if you go back to when we took over the plan back in 2006 and 2007, 70% of the accounts were out of the state. So it's been a dramatic change to switch from having very little participation within the state of Arkansas to where we are today. It's been amazing, amazing change.
And these are all direct.
Yeah, all direct. We're all direct.
This is just the direct one.
That's correct. And we can start adding, we can start adding pages here. I kind of leave it to John to talk about the advisor.
No, I just wanted to clarify. Yeah.
Absolutely. So you look at the average account funded size, you can see that, it's a short line. It's definitely lower than the last couple of years. Starting out, it's, again, all driven by the marketplace. And then you look at the average account balance by Benny age. And those people who are getting ready to go off to college, who are 17, 18, have substantially more assets in their account than the average. So that's good news. And then real quickly, just touching on the advisor plan. So the advisor plan has over 637 million. Now I will say this, for the first 7 or 8 years of the advisor plan was around, we were having a hard time cracking $100 million in assets. And then I guess about 7 years ago, we added broker dealer share classes, fee-based share classes that have really helped the program take off. So it opened up, the plan when it originally launched was really focused on nothing but RIAs. They were the only folks who could, would open up and utilize the account. Now you got RIAs and broker dealers who are selling the account. And it's been a dramatic change. So we got 16,827 funded accounts, 4,267 are in Arkansas. So the majority of the accounts are outside of the state. But the average account balance is almost $38,000. I mean, that's a substantial difference between, we see it across the board advisor plans with direct plans. And then lastly, just touching on UGIF, and we can talk about UGIF in the conversation. So UGIF is our gifting platform. It basically allows you, without any security risk, to give your account information to anyone out there, social media, your neighbor, whatever method you want to share it. And they can go to this platform that we created called ugift.com, and they answer a 4-digit number. They enter the number, and it basically recognizes that this is, Joe Smith's daughter's account, and so they know they're giving it to the person they intend. And they make a contribution through ACH or send in a check using that platform. There's, again, no security risk. The money shows up in a few days into the 529 account, and we're seeing just an incredible usage of UGIF since it launched back. Gosh, it's been 15 years now, but it's been one of our greatest success stories is the UGIF platform.
And we promote that heavily, especially around Christmas time, but then also as graduation gifts.
Sure.
If your child already has one,
Yep.
ask for people to contribute
Absolutely.
for high school graduation, put money in the fund.
Instead of
Yeah.
no offense to our good friends over at Walmart, but instead of going down and buying another toy, putting for the contribution to their account. So if you look at the success right now, again, this is the end of February. For the direct plan, we've seen almost 11,700,000 in total gifting. For the advisor plan, over 4.6 million. We've seen over 2,200 gifts for direct and over 4,000 for advisor. And obviously we know where all the money lies. The average gift for the direct plan is 520. Obviously, the average gift for the advisor plan is over 1,000. So we need more friends like those advisors.
Yeah.
And then the other item, the other relationship that we have, and this is goes back to when we launched, when I joined the company 21 years ago. The company was called UPromise, and UPromise was this idea that gentleman up in New England had to get companies, just regular companies, to help people save for college. So it was a loyalty program. So you became a UPromise member, and you entered like your tracking numbers. Often it was your credit card or grocery. It was your Kroger card number. And every time that you made purchases with those cards, you would get 2, 3, 4% of whatever you pay for those goods and services into your UPromise account. And then every quarter, UPromise to sweep those monies into your 529. It's a great program. And then Sallie Mae wound up buying the company, and Sallie Mae sold off Promise. But we've maintained, we're no longer part of Promise, but we've maintained that relationship with Promise. And money keeps flowing into these 529 plans from the Promise Loyalty Service. And just to give you an idea, for the direct plan, we've had over 2.2 million in sweeps of free money from these companies across the country through the Promise program. So it's, that's a pretty good, someone said, I'm gonna write you a check for over $2 million, put it to your accounts. That would make the press pretty well. So it's been a great success story.
I just had a question on your uptick though, and I'm sorry, I missed you said the broker dealers or the reps, who gets credit for this uptick?
So, well, I'll leave that to John, but I think it's a combination of adding more firms, but also being able to add more BDs, as opposed to just having RIAs. But John, you talk a little bit about that.
Yeah, so we had been speaking with the census and the state for a number of years about launching a broker dealer share class so that more traditional broker dealers, advisors could, like your Morgan Stanley's, your Edward Jones, Stevens, could sell the plan. Before that, the plan only had one share class. It was a fee-based share class so that if you were RIA, you can choose to opt to charge a certain percentage on the overall account balance. And that's the way the plan was structured when it first launched. The broker dealer share class just allowed traditional financial advisors to sell the plan. So we launched that successfully. We launched what's called like an A share to C share, which you would obviously know having worked in the industry. And it just opened the plan up to all the financial advisors and all the broker dealer firms, especially in the state of Arkansas. Around the same time, a tax incentive was passed as well, right? So those things happening at the same time or around the same time really launched the growth of the plan. As Dave mentioned, we were basically kind of sitting level for a long, long time. The plan growth had kind of plateaued. And then when we launched the broker dealer share classes, and you'll see that in my deck as well, like year upon year, we had massive growth in the plan. We signed up, I think at this point, we probably have around 250 broker dealers that have selling agreements for this plan. So we went from literally 0 to 250 over the span of 5 or 6 years. So that really, really opened up access to the plan. We used to hear from this office at this meeting that financial advisors had come up to different people and said, we would like to sell this plan, but there's really no incentive for us to sell this plan, and that completely changed, right? So we have, for example, over 100 Edward Jones financial advisors alone, just in the state, selling the plan. So it's really increased access. We don't hear those complaints as much anymore. It's very widely distributed in the state. People are very aware of the plan. And at the same time, obviously, the fact that the market was growing at the same time, there was a big tilt to fees dropping after the last recession. So there was a lot of fee compression in financial services in general, right? So the investments became a lot more beneficial for the average client, for a financial advisor. So all those things, contributed to the growth of the plan. And, I remember that time when we went level with the direct sold plan in terms of assets, because we had been trailing for so many years. And then, we almost hit 700 million before, the market got into its choppiness last year. So our goal is to get back there and, onward to $1 billion at some point.
Yeah, I think there's definitely a lot more revenue in this market.
Absolutely.
Good. Thank you. I didn't mean to stop your
Well, that wraps up my comments. Any questions at all?
Thank you, Dave.
Thank you, Fred.
Amanda with Vanguard, we'll move on to you.
Yes, can you hear me?
Yes, we can hear you.
Okay, perfect. I'm having some technical difficulties. You'd think 3 years into this virtual world we wouldn't, but I'm joined from my phone. But so at any point, let me know if you can't hear me. But thank you all for having me, and good morning. I haven't had the opportunity to meet yet. So my name is Amanda White. I've recently replaced Julia Ward as a relationship manager on this plan. So just wanted to introduce myself quickly before I got into the presentation. And Chris has agreed to navigator for me. So Chris, I'll just tell you what slide to go to. So today I'm going to cover 3 things. I'm going to talk about 529 industry trends. I'm going to talk about the market. as Dave had mentioned earlier, and we'll touch briefly on investment performance. So let's start on slide 4 on the 529 industry trends. So on the investment product front, target enrollment portfolios, and this is important to you all. So you all had converted to target enrollment portfolios last year. Vanguard first introduced these portfolios in 2020. And what we saw from an industry perspective is we saw, well, hearing me?
What? Yeah, we can hear you.
What we saw from an industry perspective is, and a lot of your peers were converting to these target enrollment portfolios over the last several years. We've started to see that slow recently.
Hey, Amanda,
think
you're cutting in and out.
Yeah.
Let me do that then. Okay, I'll get off of the AirPods. You'd think they would work. So I'll just start from the beginning. So target enrollment portfolios, which you all had converted to back in 2020. We've seen a pretty big uptick over the last 3 years of, other 529 plans, yourself included, converting to these target enrollment portfolios. What they were doing were replacing the age-based track. So that was a big trend we saw over the last several years. We're starting to see a little bit of a decrease in the plans moving into that. We're kind of keeping an eye on it. I think the majority of the Vanguard portfolios that we work with, most of them have already converted. We do have a couple that are not interested at this point, but we are seeing Morningstar as a big push to have certain plans move. So something we're keeping an eye on, something as you talk to any of your peers in the, within the 529 space, you might hear more about. The other thing I wanted to touch on.
Are there things you attribute that slow growth or slow movement to? Do you think it's people just not understanding what it is, or what are your thoughts?
So very good question. So I'd say there's probably 2 parts to it. So there's the people who have already decided they were going to do it, such as Arkansas. They've already done it. Some of the other things we're hearing as to why they're not is they think, in some cases, the plans are thinking that they're taking something away from their plan participants. So if you're familiar with the age-based portfolios, the way Vanguard did it, we had 3 different portfolios you could choose from. You go from 3 to 1 with the target enrollment portfolios. Now, all the research we've done is investors actually benefit from less choices because it helps streamline the choices that they make. But for whatever reason, we do have some of our other plans that we work with that they just feel like they'd be taking something away from their portfolios or from their participants. That's what we've mostly heard.
Okay, thank you.
So I just want to touch quickly on the Secure Act 2.0. I don't know if this has been brought up at all. If you're familiar, there was a big bill that was passed in December, and one part of the bill was the ability to roll over 529 plan assets to a Roth IRA. So that won't start until 2024 for eligible assets and plans. And what we're seeing is just a lot of the states are just, they're currently working through the logistics. They only have a year to make the changes. So trying to figure out, how this would impact them, do they conform, and what the next steps look like for them. So that's something we're hearing a lot of our states talk about as well within the industry. And then lastly, what I will touch on, I'll pause there for a second.
We're good.
And then lastly, what I will touch on, and this will go over into the next section, is the markets. So I don't think this is a surprise to anybody here, but 2022 was a really rough year for the markets. So inflation was at a 40-year high. We had interest rates increasing at a rapid pace as a result of this historic inflation. And both the equity and fixed income markets were down for the year, which is an anomaly we've only seen 4 times in the last 80 years. So with this backdrop, and I know that Dave had touched on this earlier, the 529 industry as a whole saw a decrease in cash flows for the year. That was compared to 2021. So really, this isn't that big of a surprise, as I know we've seen this in past years. And just to kind of add additional context, so Vanguard enterprise-wide, our cash flow was only about a third of what it was in 2022 versus 2021. And we saw that again throughout the entire industry. But we continue to be optimistic about the viability of the products that we have. And then especially, if you think about it, with the fixed income market, with rates rising as rapidly as they did, it was a big hit. But as a fixed income investor, you're going to start realizing those coupon payments. So it'll start playing out within the products that you invest in. So like I said, I'll touch more on this in the next section, which Chris has already moved to, but I just wanted to pause for any questions there.
Questions, comments?
I think we're good.
Okay, good. And Chris, you can stay right here on slide 6. So we've already discussed the challenging market environment. So a few important things, though, I do want to point out on this slide. So while 1-year returns were negative for 2022, the fourth quarter returns were positive, which you'll see the light blue, I guess it's a teal color bar on the left. And we've actually seen this trend continue into the first 2 months of this year, with both the domestic and international markets up. We are also, and I say this kind of a little bit, I don't want to say nervously, but we are starting to see the rate of inflation beginning to slow, in a large part due to the aggressive actions that the Fed took. There are a couple interesting things happening within the markets that I think are having, economists kind of scratching their heads, which I'll get to in a little bit. But overall, the Fed still does have some work to do, and they do anticipate increasing rates at their next 2 meetings, albeit most likely a little bit of a smaller pace. So with this, I'll move to slide 9. Chris, please. Okay, and I did want to spend some time on the fixed income market just because it did get so much attention in 2022. So the fixed income market typically acts as a ballast to most portfolios. So a lot of the portfolios that your plan participants invest in are a mix of stocks and bonds. And a lot of times in a down market, it's a down equity market, and the fixed income will act as almost a cushion for that downside. We did not see that in 2022. As you can see here, the Barclays U.S. aggregate had its worst year ever at a negative 13%. And, we are anticipating, the Fed has signaled they're going to continue to raise rates just to help combat the inflation. Although we do see it being at a smaller pace. So not the larger 75 basis point increases that we saw in 2022. So Chris, if you want to move to slide 12, this leads us to our outlook for the year and beyond. So at the beginning of the year, we assigned a 90% probability of a recession here in the US in 2023. So as I mentioned earlier, I think David mentioned too in some of his comments, this has been an interesting start to the year. So last month, there was a very strong labor report that, again, caused a lot of economists to scratch their heads. So 2 months into the year, we don't see that the Fed's actions have impacted the consumer as much as we would have expected that they did. So that being said, we've kind of pushed our probability of a recession this year to either later this year, maybe even into 2024. And if you look at GDP growth on here, our consensus, this would have been as of November, was a 25 basis point growth for the year for the US. We're now looking at a 75 basis point growth for the US, just based on some of the things we're seeing in the market. On the unemployment front, as I mentioned, we did receive a stronger than expected jobs report in January. Our current unemployment rate's at about 3.4%. Our expectations are still, though, that the labor market should start to cool in the second half of the year. And we expect an unemployment rate at the end of the year at about 4.5% to 5%. From inflation standpoint, we expect inflation to end the year around 3%. I think a December reading was at 4.6%, so still high for what the Fed would like to see, which is why they continue to mention that they're going to continue to raise rates. And then kind of tied to that, our forecast for monetary policy. Here it says a 5% at the end of the year. We're looking at a slightly higher, just given some of the reports we've seen lately. So we're looking at a peak at about 5.5% to 5.75% for the Fed and for them raising rates. So what does this mean to the investor, right? And this is why we're looking at this. If you turn to slide 13, Chris. So these are our return projections for stocks and bonds. Our return, so longer term, our global equity outlook is improving because of the lower valuations and higher interest rates. They're actually about 2.25% percentage points higher than they were last year. We're still seeing U.S. equity valuations as they're more attractive than they've been, but we still see them above fair value, which is why we have our estimates at lower for U.S. versus domestic. And then also just to mention the bonds here, so we're looking at 4 to 5% for U.S. aggregate bonds. I think last year at this time, our outlook was 2.7 percentage points lower than that. So really, that's just the impact of what the Fed's doing, interest rates rising, and the potential or the impact on the bond market on the long term is really positive for the investor, for the long-term investor. I've paused here for questions before we go into performance of the portfolios.
I have a comment. You mentioned that you think rates by the end of the year would be at 5.75. I've read 5.25, 5.5, but do you feel, could you elaborate just a little bit on possibly the 5.75?
So that would just be, where it is right now, and Chris, I don't know if you don't mind going back to that slide, that would be helpful on my side here too. Yeah, so right here, so we're at about, I think we're at about 4.5% right now. And we initially didn't anticipate, I think we initially anticipated only 2 or 3 rate increases for 2023. Now we're anticipating more, just given what the economy does not seem to be, or the consumer in particular does not seem to be kind of slowing down, if you will, based on what the Fed has been doing. So that's why we are seeing it higher, whether it be higher increases or maybe, I think initially our estimate was by mid-year, we would start seeing them pause on rate increases. I think our thought is that's no longer the case. We're going to continue to see rate increases throughout the year.
Thank you.
Does that answer your question?
Yes.
Okay.
Does anyone have any questions?
Any other questions?
I think we can move on.
Okay. And then just slide 19, Chris, and I won't spend too much time in this section. I feel like, this is all market related. So, really, there really was nowhere to hide in 2022. I'd say our only positive performer for the year was the income portfolio. So you're seeing just that portfolio do well. Everything else kind of, I would say, performed as you would expect. For those of you that have been in the room here for a couple years, in 2020 there was with the large downturn in 2020, March of 2020, we did see some performance differentials as a result of that. We are still seeing that in the 3-year number a little bit, but our hope is that will eventually kind of fall off as time goes on. So any questions on performance or any of the portfolios?
I think we're good.
Okay. Well, thank you very much.
Thank you, Amanda. Now we're next report. It's all right, Brian.
All right, great.
Yes, it is now time for Mr. John Park.
Thanks for having me here again. Maybe I should just touch a little bit on my background since the first meeting with the new administration. So I was on the broker-dealer side of the business for a long time as well. So I actually worked at Morgan Stanley also, and before that, Smith Barney before the Great Recession in 2010 when Citigroup spun off Smith Barney to Morgan Stanley. So I've been on the product side of the broker-dealer side of the business for a long time before I came over to BlackRock. And then I basically went to the other side of the relationship, which was, on the asset management side of offering different financial products to what were my sort of competitors on the broker-dealer side of the business before, and now they're my clients. Right, so we deal with all of the major home offices in the industry. BlackRock has the largest wholesaling force in the asset management industry. So we're very, very active and engaged with every single major distribution partner out in the industry. So that's a little bit about my background. So I will get into some of the things about the plan, starting on page 4. So just like a brief review of the plan in general, in the iShares Advisor Sold plan, we are offering a competitive, passive, index-based set of products, very cheap, and obviously we offer our investment expertise in terms of glide path construction, right? So at the core of the iShares plan, we have what are called core iShares ETFs, which are based on well-known indexes. We try to offer them at some of the most competitive prices in the industry. So from between 3 and 9 basis points, which are literally 3/100ths of a percentage point, right? So super cheap product. As 2 examples there, we have the iShares Core US Aggregate Bond ETF, which offers broad fixed income exposure, which we have at a 3 basis point management fee. Same thing with the iShares Core S&P Total US stock market portfolio, which offers broad US stock exposure at 3 basis points as well. As I mentioned, this plan continues to be one of the cheapest advisor sold plans in the industry. The average expense ratio for the year of enrollment portfolios within the advisor sold plan is 47 basis points. The big dog in the advisor sold space is American Funds, right? So it's the Capital Group. And this plan is competitive with the year of enrollment pricing for American Funds. And we also offer a 0 fee F share, which we talked about earlier, which has no sales charge. And it allows RIAs that set their own fee-based pricing to set whatever pricing that they feel is appropriate for their clients, right? So you have choice. Either you can be a broker-dealer advisor, you could be an RIA, and you can offer either way one of the cheapest advisor sold plans in the industry. We talked about employer pricing as well, right? If you're an employer in the state, you have the advantage of offering either plan, either the direct sold plan or the advisor sold plan at 0 fees, right? So both plans are very, very competitive from an employer perspective. Most state plans, they would not offer that in that way. Would, if it's being offered by a broker dealer financial services advisor, you would probably be getting A and NAV for an employer plan. But in this plan, you can offer the fee-based plan, and an employer can take advantage of either they want to be in Vanguard investments, they want to be in iShares investments. Either way, you're getting very, very low fee index-based exposure. So they have that choice, which is an advantage. The other thing that BlackRock offers is that we have a lot of depth as far as constructing the glide paths, which are just another way of saying year of enrollment portfolios. As your beneficiary ages to college age, from the time of birth, they go from more equity heavy portfolios that are riskier to more fixed income portfolios over time, right? As the child's getting closer to their enrollment time, obviously you want to be in a portfolio that's more stable and less exposed to the ups and downs of the stock market. So the glide path just lets you do that, right? So the same team that manages the glide path for this advisor sold plan also manages the glide path for our whole entire retirement franchise, which is known as Life Path Target Dates. The slide 5 just talks about that. These are the 7 year of enrollment, otherwise known as target date in the retirement space portfolios. And you can see the representation that when you're about to go to college, you're 100% fixed income. And then as you are farther away and your child's just recently born, you're more exposed to equities. For clients that just want a particular risk exposure, you can go and stay in a fixed portfolio that's not changing its allocation. So you can stay in either an aggressive, moderate, conservative, or all fixed income portfolio. So you have that set of options as well. And then if you want to construct a custom asset allocation, which is on slide 7, you can choose from a number of different building blocks that again are iShares, low priced index exposures. And lastly, if you want to be in, the most conservative option that you can have, you can be in an FDIC insured product, which is the savings portfolio, which for the longest time basically yielded nothing, but now you're getting substantial yield. So, these products we're seeing a lot more interest in FDIC insured savings portfolios because for the first time you can actually get some yield out of them. So that's a recap of just what's offered within the plan. If we can go to slide 9, which we have up there. This is just a little bit of you can see on the top, a little bit of the growth that we've had in the plan since year end 2017. You can see that, we had pretty substantial increases over time, year over year, as we launched the share classes. And, we were excited to be able to offer the product and have more conversations with more financial advisors and broker dealers, specifically in the state of Arkansas, which we can, touch on another slide. But so we have been, just kind of riding that wave of more index-based investing, more focus on fees, RIAs continuing to grow on that side of the industry. So that's been a huge plus, as well as, again, the introduction of an improvement of the in-state tax incentives. So that was huge for the industry as well. So those are some of the things that have just provided tailwinds to this plan. And then on slide 10, sorry, somehow the asterisk got dropped here, but the asterisk indicates that this was the growth the growth or change, I should say, since the end of 2022. So just for 2 months, right? So assets, as Dave mentioned, they have rebounded a bit. As we've all discussed, 2022 was a super challenging year for the markets. Sort of unprecedented in terms of the correlation of bad bond market returns, as well as pretty bad or horrible equity returns. So that led to a real drop in balances overall, but thankfully the fourth quarter going into, the beginning of this quarter anyway, we've had some positive growth in the markets. And so assets just within the state of Arkansas are 66 million. So, just to remind you, we have about 630 million within the plan. So over 10% of the assets just have grown within the state. So that's been, tremendously positive. Since year end 2021, because we've had this little bit of a bounce back, assets have a minus 7% change. So you can see that it's, we're clawing back that, asset size. The number of firms, after having a lot of growth within the state, have kind of leveled off. I think we've just basically hit a saturation point. And there continues to be a lot of M&A activity with firms just in general nationwide. So you have broker-dealer firms like merging all the time, right? So that's led to, I think, a slight reduction in the number of firms, but essentially we have 55 firms that distribute the plan within the state. That's the same number of firms that we had at the year end 2021. Financial advisors, again, similar trend. I think whenever you have a really, really, really tough year for the financial markets, you have some shrinkage in the total number of financial advisors in the country, just because it's harder to make a buck. And especially if you're starting out, starting out in the year where you have historically bad market returns is not going to allow you to build your business. So we've had a slight drop in financial advisors, but again, overall 11% increase in the state since the year end 2021 anyway. Slight increase in the accounts. It wasn't enough to be 1% since the end of 2022, but 3,950 accounts, again, a 10% increase since the end of 2021. So despite the bad market in 2022, we had an overall increase in advisors for the full year plus the 2 months. So, we've had growth within the state, and although the average account size is slightly up since the end of last year, obviously you see that it's down since the end of 2021. And that's not necessarily a bad thing, because when you have the number of accounts growing, right, the average account size is going to go down, plus the market went down as well, right? So that's going to shrink the overall average account size. But, when you talk about net sales, for example, Dave showed that we had positive net sales. For the longest time, many 529 plans had negative net sales while the market was riding high. And the reason for that is that, it's hard to outpace the market growth, right? People draw down on their accounts when their child's ready to go to school. And that's when accounts are essentially hitting maximum size, right? So you have to grow the plan at the same rate that the market is going up every single year. And if the market's going up every single year, in many cases, double digits for a decade, it's hard to compete with that as people are drawing down the biggest accounts, right? So you had negative net sales. Now we have positive net sales, but for the bad reason, right? Which is what I always said, you can have positive net sales if the market shrinks a lot, because now their accounts are a lot smaller, right? So we're still getting money in the door, but now the withdrawals are smaller because they don't have as much in their accounts. So you are seeing that across the industry. We talked about Secure 2.0. Vanguard mentioned it as well. One of the positives for the advisor conversation is that one of the biggest hesitations for an advisor to put their client into a 529 account is what happens if your child doesn't go to college, right? So to have that other thing to be able to say, which is that if your child doesn't use all this money, which, let's face it, most people don't have enough money when their child is going to college, right? They haven't saved 100% of what they need. We saw the average account balances are, in this plan is 35,000. The direct plan is smaller. It costs a lot more than $35,000 to send your child to college. So there are very few people that are faced with, oh, I have too much money in my account. But, when you're starting off that conversation and introducing that concept to a client, sometimes it's a reason why somebody doesn't want to open an account. And if you can remove all those reasons, it just makes it easier to have that savings conversation. So on the advisor side of the equation, it's seen as a big plus. The broker dealers are very, very excited about it. I've had one-on-one conversations with UBS, with Edward Jones, with a lot of broker dealers that are very, very excited that Secure 2.0 has passed, even though, number one, it hasn't started. It starts on January 1st, 2024. And there are some details which we don't have answers for. in terms of how that mechanism of the moving the money from the 529 plan to a Roth IRA, how that's actually going to work in practice. But the good thing is that it broadens the conversation. It removes that hesitation to open an account. And as we just discussed before, that's the most important thing. You need to break down those barriers to getting people to start thinking about college savings. So we're excited about it, even though there's still, details to work out. I also brought a commentary piece in terms of, our view on the markets, but a lot of it also does kind of, dovetail with what was in the Vanguard presentation. Dave and I were discussing on the way over here that, and obviously the biggest question is inflation, how central banks are going to continue to react to it. I heard the best kind of simplified explanation of why it's so important to tamp down persistent high inflation is that if you are raising rates and you bring on a recession, some people will lose jobs. There will be, the stock markets might get hurt, for example, but when you have persistently high inflation, it hurts everybody in society, right? It hurts the retiree on a fixed income. It hurts, people that have jobs because their salary gains are not increasing at the same rate that inflation is. So everybody ends up losing money, and that ends up being like corrosive to the standard of living of all Americans, right? So the Fed is going to continue, like nobody should be surprised by Jerome Powell's comments today, because the last 3, 4, 5 set of economic indicators have all pointed to like persistent, stubborn inflation. And when that happens, then that the Fed is going to be postured to continue to raise rates because they have to kill that inflation beast, right? When you have indicators going in both directions, then there's a level of uncertainty in terms of what the Fed is going to do. But if jobs end up being persistently high, if spending and consumption end up being persistently high, then the Fed has to keep kind of banging that drum of trying to slow down inflation. And that's the challenge that they're having, because there's a lot of things that have changed during the pandemic. A lot of people that are kind of on the front lines of a lot of those hourly wage types of jobs, in the service sector, waitressing or construction or whatever, they move to, in some cases, they moved home to their parents. They don't live in New York City anymore. They might have moved back to Iowa or something like that. And then now they work a 9-to-5 job. It maybe is not as exciting, but they realize that stability has its own positives, right? So maybe they have benefits now, and they were working on hourly wages and tips before, and going back and filling those types of jobs. All of those sectors are having a very, very hard time finding employees, because there's been some migratory demographic shifts all throughout the economy. So we think that it's going to be tough. The labor market is going to continue to remain tight. But there are indicators, for example, that people are continuing to fuel their lifestyle and consumption, not with wage increases, but with more credit card spending. So you see credit card levels and credit card debt going up now, and that's just not sustainable in the long term, especially as rates are rising. Now they're having to pay more interest, right? So we think that there is an end in sight, but like Vanguard, I think, looking at Vanguard's predictions versus consensus, I would say that BlackRock's in kind of that same boat as well. We think that there's going to be a recession at some point. When that's coming is hard to say, but at the end of the day, we think that the Fed is continuing to do the right thing, and they have to do it. Otherwise, you kind of just potentially let the genie out of the bottle in terms of persistently high inflation, which nobody wants. Yes,
Sorry, I
Yeah,
have
go
a
for it.
question, circling back to the Secure 2.0 Act and the Roth IRA rollover. One of the provisions in there is that the 529 account has to be 15 years of age itself.
Yes.
Is there any industry talk about trying to get that tweaked down a bit?
So I've been involved in a lot of those conversations. So, the College Savings Foundation, College Savings Plan Network, which is, a subset of the National Association of State Treasurers, and SIFMA are all working on an industry letter to send over to Treasury to try to get more definition around these things. I don't think that the 15-year part of it is going to change, but I think that what people are concerned about are, what happens if I roll from one plan to another? Does that reset the 15-year clock? What happens if I change my beneficiary, right? Like a lot of people have 2 children. They put one kid through college and then they change the beneficiary to their next kid. And does that reset the clock? Because the Roth IRA provision allows for you to move that money to a Roth IRA for the beneficiary, right? A lot of people have themselves as a beneficiary because they opened the account before the child was born, right? So do any of those changes result in the clock being reset, right? So a lot of financial advisors are really, really concerned about that because they want to be able to, provide a certain answer to their client who might be thinking about doing one of these things. So we want to get direction on that, but what all of the industry lobbyists and attorneys have said to us is that there was so much retirement stuff in Secure 2.0 in general that the IRS and Treasury are going to be spending the next year and a half examining how all of that stuff is going to be applied. So they think that there might not be answers for the 529 industry for a year. So even after this kicks off in the beginning of 2024, we still might not have definition around exactly how it's going to be applied, which is not the best. But and the other thing as well is that there are already states that have come out that said that they are not going to allow the rollover. So like when K through 12 came out as a qualified expense for 529, there's 2 things. One, a lot of states just have enabling legislation that whatever comes out on the federal side automatically gets applied to the plan rules. But Arkansas, I believe, does not have that, right? So Arkansas had to pass another piece of legislation that enabled K through 12 to become a qualified expense. So there are some states that just don't have that, right? So it's going to take some time for all the states to adopt that. And then there are still some states that decided not to adopt K through 12. Some states have clawback of their tax deductions or tax benefits. So if the money moves out of the account. So all of that needs to be sorted out. It's kind of a nightmare for broker dealers because they would love it if all these plan rules were adopted uniformly across all 529 plans, because it's already a difficult 529 conversation because you have all these different state tax benefits, right? So why should I buy the Virginia plan over the Arkansas plan versus whatever, California or whatever? So that just makes it a more complicated conversation for financial advisors. And then to have another set of rules like K through 12 that are not uniformly adopted, and then this rollover that's not uniformly adopted, it just makes the conversation more complex. And financial advisors like to keep everything really, really simple. They want to understand it, make it easy to sell, whatever. So there's still some wood to chop out there as far as getting people to be able to talk about this smoothly. But great question.
Really appreciate your report. It's good.
Thank you.
Any questions for John? All right, next we have Greg and Patty.
No, we have done peace.
I'm sorry.
Okay.
He's got
I
this.
guess 2 short reports. First on the budget, the plan receives fees from both the iShares and the Vanguard plan, and that was negotiated when the census, you promised them the census took over in mid-2000, and those have continued to increase over the years as the plan has increased. We're budgeting this year to have about $700,000 of admin fees, and that's used primarily for marketing in-state and also some for legal and accounting fees. The 8-month period ended February 28th, we're probably about $40,000 under budget, and due to the market downturn. The expenses seem to be pretty much in line with what we had budgeted. The income exceeded the expenses by a little over $5,000 for the 9-month period. at the end of February, we had $221,000 in the Southern Bank corporate account, which is the main account used to pay expenses. And about $9,300 in the first security account, so a total of $230,000. And with the income that we'll receive for the next 4 months, we should be within what we budgeted for the year. Be happy to answer any questions. If not, Fran asked me to report on the status in Congress of the ability to use 529 funds for homeschool expenses, because of course during the pandemic, but people started doing a lot of homeschooling, and as the pandemic recedes, they found out that's a pretty good way to educate your child, so they're staying in homeschool expenses. I mean, in homeschooling, but they do have expenses. They have to buy books, they have to take standardized tests, other things. And when the legislation was, I guess it was the Tax Cuts and Jobs Act in 2017 to become effective in 2018, there was a push at the end to add homeschool expenses, which died in committee, or it died because of some sort of procedural thing that the Democrats were able to get through. And it was reintroduced in January of 2018. Went to the Ways and Means Committee, where it eventually died. Never got out of the Ways and Means. That Congress ended in December 2022. The new Congress, the 118th Congress, I guess, that started in January. And I'm sorry, the 117th Congress that started in January of 2021 through 2022. Senator Ted Cruz introduced a similar amendment that would make homeschool expenses payable through 529. That went to the Senate Finance Committee, and it never got out of that committee. So in 2023, we've got a new Congress. The Republicans have a slight advantage in the House. My feeling is that it'll probably be reintroduced in the House, have a good chance of passing in the House. Then we don't know what's going to happen when it gets over to the Senate, but there's a good chance for the next 2 years, there'll be some movement to allow homeschool expenses. And it's good for not just those that are homeschooling, but right now for K through 12, you can only use it for tuition in private school. And this would open that up to also be able to use those for books and criteria, curriculum and things like that. So it would help not just the homeschoolers, but also those that are going to private school.
Information.
Yeah, thank you, Sharon.
Thank you, John.
Now,
Last but not least. So excited for these. So just to introduce us to the people on the phone who we haven't met before, and to you guys, I'm Patty Davidson, this is Fred Walker. We started our journey in the 529 industry in 2008. We owe a debt of gratitude to this committee and to Mr. P specifically, because he asked us to propose against some of the larger firms on doing the audit. And we were like, we don't want to do one of anything. And so now we do work with about 25 plans across the United States. Yeah, it's pretty exciting. And Greg and I have a team of about 10 people, give or take, depends on what week it is. And we focus most of our year working on ABLE plans, 529 plans, and state facilitated retirement plans. So unlike any firm, as far as I'm aware, in the United States, we have a team of dedicated people, and we have an expertise in this industry. We're super proud of that.
Yeah, and just as a comment, I've seen firms 529 business grow tremendously over that time period. It's been amazing to have, a firm based in the state of Arkansas really just have to be a super significant player in the space. So
I would say that you guys own this space.
yeah.
It's pretty exciting. I mean, it's been a big accomplishment, and there have been a lot of hours and tears that have gone into developing this expertise, but we are here today to present to you the audit reports for both the direct and the advisory plan. And obviously these are big old documents, so we won't be going through all of the details, but each of the documents is organized the same way. We have management's discussion and analysis, we have an auditor's opinion, we have financial statements, we have footnotes, and then supplementary information. And so I'm going to focus on the direct plan specifically, and then if there's any variation in the advisor plan, we'll point that out. And I know obviously time is of the essence, so we'll be as brief as possible. And I will say, just in general, we appreciate the cooperation that we receive from BlackRock and Ascensus, because we couldn't do this without their help. And we nag them to death for information. We ask lots of questions. And because we work with so many plans, we do it almost all year round. So thank goodness there's different relationship managers on different programs. But both plans did receive a clean opinion. And our focus in doing these audits is really to determine from a macro level that the numbers are right, or as close to possible, as close to right as possible. And then that the programs are being operated in accordance with the program description at a participant level. So that's our big picture. And I'll let Greg just walk through one of the reports quickly and talk about significant disclosures, so you all can have a little more detail on what went on last year.
Sure. So, yeah, since Census and BlackRock and Vanguard have already kind of covered numbers through 12/31, we're not going to go back to June 30, 2022. So we're going to start on the direct plan on page, add it, and then on page 19. So note 1. And I'll be pretty brief, kind of give an overarching description of the notes. And if anybody has any questions, we can go in more discussion on that. So note 1 is probably the most important, especially for this past year because of the name changes. I'll wait until.
Yeah,
the other
sorry,
product.
he's got a lot going
I
on
read-
here.
You're fine.
We're in this one with
19.
with the red star.
Red star.
There, thank
That's
you, I
all right.
apologize.
Oh, you're fine. So there was quite a few, pretty much every name associated with the plans changed from 2021 to 2022. And so you'll see in note 1A, it was reworded and reworked. And so we explained each of those changes. Also, I'm going to kind of go back.
I love the name change, by the way. I don't know whose idea that was, but the brighter future.
So if you want a very Cliff Notes version, which is the management discussion analysis on page 7 in the middle, you'll see those bullet points. That's a quick and dirty version of the name changes for the plans, the program, the act,
The trust.
the trust. But going back to page 19, not only is it talks about, the name changes, but the who's who in the plan, what the committee does in relation to the plan, what a census does, what Vanguard does, and what Bank of New York Mellon does as custodian. Note 2 is your significant accounting policies. This describes, how investments are valued. It explains when contributions and withdrawals are reported for the plan, and things of that nature. There's no changes from the previous year in relation to significant accounting policies. Otherwise, we would have pointed that out in note 2. Note 3 is going to be your biggest note, and probably the most outside of note 4, probably the one that people look at the most. It's the investments by type. So on page 24, starting at the bottom, by portfolio, and I know that these changed from the age-based portfolios to the year of enrollment, September of 2022. So next year will look pretty different, but for each portfolio, it breaks it down to each underlying funds and kind of what makes up each portfolio. In addition to that, there is a separate account that Vanguard maintains for the plan that is made up of investment contracts and a money market mutual fund. That's on page 29. Kind of gives a breakdown of that. After that, it gets really fun with all the investment risks. These are required by standards that we disclose. It's pretty standard language across all the 529 plans that we audit. Talks about the investment policy, which the committee did approve this past going into 2022. So that verbiage did change a little bit, just kind of explains briefly what the objectives of that investment policy are. You have credit risk, interest rate risk, or currency risk. Again, this is standard language. On page 32 is probably the most important note, and that's note 4, administrative fees and expenses. We'll get a little bit more in depth with the procedures of the form over these, but this explains, what kind of administrative fees are for the plan, who received what funds. In addition, to note 4C, it's the amount of money the committee spends on implementation of the program and the plans itself. Lastly, on page 33 is market uncertainties. Based on everybody's conversation today, it's still, the market is very volatile. Going forward, we hope to take out the first paragraph, the COVID-19 paragraph. That is our hope. And
It'd
that,
help to take out both of them.
that would be great to take out both.
For the Ukraine, if you think about that.
So that is, that does it for the notes. Any questions on those? Angus, or what you were just looking at, that kind of breaks down, the financial statements are the plan level as a whole. And so what those, the supplementary schedules in the back, it breaks it down by portfolio. So those totals for all the portfolios will match up to the actual financial statements earlier in the document.
Okay.
So it gives you a little bit more information, along with the outstanding shares and the OAV portfolios.
Now, how long has Landmark been involved with that?
2008.
That's great.
Mhm.
And I will point out, if you're so inclined, the management's discussion and analysis on pages 6 through 11, 12, 6 through 13, that's the cliff notes to everything in the back. So if you don't want to dig into the details of the financial statements or the notes or the supplementary schedules in the back, everything is summarized for you up here in NDNA up front, similar to what you would see, but not quite as detailed in a prospectus or, a mutual fund document.
I like it.
Yeah, I know everyone loves the NDNA, but we do want to draw your attention to the notes because they are kind of important and significant. There's a letter that accompanies each one of the reports. The letter contains required communication, so if we have issues, findings, it is a separate document. See if y'all have that.
It's like this.
Just a plain letter. If anything arisen during the audit that we consider to be problematic, we would be required to disclose that to you guys here. We didn't have any issues or findings. And so most of this language is boilerplate. We also do confirm that we are independent with respect to the program and with respect to the committee members. We don't have any other relationships that we would be required to disclose here. And I think an important part of this letter is on page 2, and it says significant risks identified. And I will let Barry talk about the significant risks that we identified during our Factory 9 plan audits and what we do to address those risks.
I'll go back to the previous paragraph, the compliance with all ethics requirements regarding independence. In addition to us saying that we are independent, we also point out that we do some services that are above and beyond a normal audit. So when we get information from Vanguard, the numbers are on a settlement date basis. To be in accordance with GAAP, we adjust both underlying fund transactions and participant transactions to trade date. And we also perform some other small accounting entries. And so what we're saying here is that we perform these, we are engaged to perform these, but they're outside of the scope. And in doing that, there's a risk that, we could do something wrong, but we have implemented a number of steps. So what we have, as Patty has said, we have a team of 10. Sometimes it can go up to 15, but outside of the actual engagement team on this plan, we have some of those team members that don't work on it, perform those entries. And so when they're done with those entries, it comes to our engagement team and we will review those at least once, usually 2, including one of those being me and Patty as the final reviewer. In addition, Census, as program manager, takes responsibility for those, but we wanted to point that out. But going into the significant risks identified, based on since 2008, since these were started, we believe that the one-off changes from the plans, whether it be an asset-based fees change, a portfolio opening or closing, or even underlying fund change, those are the situations that when they happen, there's a chance that something could go wrong. Based on how everything is set up and the controls in place, a normal routine transaction probably is not going to have any issues with it. But with the portfolio opening, then there's a chance that accrual for the asset-based fees aren't charged, or if there was supposed to be a reduction because a breakpoint was reached, there's a risk that it didn't get made for 2 months later. And so we're just pointing these out that those are significant risks that we have identified. Also, the administrative fees in general, we spend a lot of time on. Of course, the committee wants to get paid, Vanguard wants to get paid, BlackRock wants to get paid, Census wants to get paid. And we recalculate those not only at a plan-wide level, but usually we'll go in and we'll recalculate those at a portfolio level. And we'll compare those to the program description and make sure there's no discrepancies. We found no discrepancies in either the iShares plan, or I'm sorry, the advisor plan or the direct plan. But outside of those other significant items, there was no portfolio changes or any asset-based changes for the direct plan. For the advisor plan, there was one of the year enrollment portfolios did close into the college portfolio, and then another one was open. And what we did there is we made sure the asset-based fees began to be accrued at the correct date for the correct amount. We also made sure that the portfolio closed on the day it was supposed to, and then it zeroed out. So those are the significant risks that we've identified, and that's kind of the procedures that we did to make sure that everything was good to go.
And in our 15 years, if something could go wrong, we've seen it.
Yeah.
So if you were the auditee, that's unfortunate for you because we are testing for everything we've seen over a 15-year period. Yeah. And usually it does revolve around asset-based fees, and everybody's so sensitive to the fee calculation. So we do spend a lot of time there.
Do you have other plans that have transitioned from the age-based to the?
And I was gonna point that out. This letter will look a lot different next year
Yeah.
because
It'll have a pretty big section of that.
Yeah, that's what I wondered.
But yes,
because
ma'am,
timing.
so we audit 4 others
Mhm.
that Vanguard is the primary investment manager. And this, outside of another one, this was the last one to go from age-based to year of enrollment. But
Okay.
every other Vanguard plan has gone there.
So next year, next year's
Yeah,
report
so
will.
we will take participants and based on their date of birth and the mapping that a census will provide, we'll make sure that they went into the correct year of enrollment portfolio. And we have not had any problems with the ones we tested. The census has developed over the past 8 or so years, a pretty extensive testing program. When they are going to implement a change, they have a whole team. And we actually look at the testing that they do and we do our own testing, because the worst thing that could happen is you go through this migration and people end up in the wrong place.
Right.
And then that gets in the paper and
Mhm.
somebody's mismanaged something, and
Mhm,
so
mhm.
we really.
We tried that.
It
Yeah.
did, yep.
Yeah.
And we've seen it, and so that's why we try hard to be your watchdog with these plans and with respect to operations, because we work for the committee and we want to be sure that we are comfortable reporting to you guys that the plans are operated in accordance with the program description and that the changes happen as planned and they're accurate. So we do a lot of work, especially when there's a change.
We kind of cut our teeth on the advisor plan because they've always been targeted. So ever since I've been with the company, every 3 years I submit a project to open up a new portfolio and pulls the oldest one down,
Mm.
which is what we'll be doing now on the direct.
Okay.
Does anybody have any questions of Craig or Patty? That's a very good report.
Yeah, it's helpful. I mean, I've worked with y'all now for 3 years and I just learned so much today. So thank you. That was interesting.
I always feel like such a Monday morning quarterback, though. It's like, we're talking about, interest rates going forward and we're looking at numbers at June 30.
Yeah.
2022. That's why I try not to focus on the numbers so much as what we do, because I think what we do is great value.
Absolutely.
Yeah, and thank you all for everything you do. Not everybody would want to do what y'all do. Going back that intensely and looking at every building. Yeah, the next year's audit values are a lot higher.
Yeah.
I think
It's new business.
the only thing that I have, at least under new business, unless anybody else wants to bring anything, is I'd like to propose we go ahead and schedule the remaining 3 meetings. I mean, we'll obviously follow up with an email, but I know typically we'll just kind of schedule the next one, but I just thought it might be helpful to the degree that we can, at least let's go ahead and look at the rest of the year. So for the next meeting, considering June 20th, and these are all Tuesdays. Then August 29th and November 28th, which is the week after Thanksgiving. So we will follow up with an email, but again, if you're jotting these down, June 20, August 29, November 28, 10 o'clock, all Tuesdays.
What was the last one, November?
November 28. So June 20, August 29, November 28.
Just a quick housekeeping note, Alicia had to hop off, so we're in a quorum now, so you could make the motion whenever you're ready.
Visit.
Or Ron.
I just want, on new business though, anyone new business? Okay. Again, I just want to say, I'm sorry that the Treasurer Lowry got tied up today, wouldn't be here. He's still, maybe he'll make it here.
It's a long meeting.
But again, it's a very good meeting, very informative. I just want to recognize our staff, in front of y'all. We've been through a transition and we're still not at 100 days, but we have, I know that Fran and Chris work very hard at this program, and want to make sure there's good communication with you all and everyone. And again, I have some personal history with it, familiar with it. It's important to keep growing, plan, and it's a great opportunity for families out there, a lot for education opportunities for people. At that, do we have a motion to adjourn?
So moved.
We have a motion. Is there a second?
I don't think anything.
I'll second.
Yeah.
I think that's up there. We are adjourned. Thank you. Thank you, Amanda.
Thank you.
Yeah, thank you both. We'll follow up later.